Hi, and welcome back to our Bollinger Band Essentials training. We're getting into class number 4, which means we're going to start talking about pulling everything together into the actual plays that we use with our Bollinger Band. So there's 3 specific plays. We've already talked about them. We've got the squeeze, we've got the trend trade, and the reversal play. We're going to look at those here, and then we'll do a quick wrap-up. And by the time we're done with this, you're going to have a pretty good idea of how to start trading with Bollinger Bands. So let's take a look at the first one here, play number 1, which is the squeeze play. Now, the squeeze play is going to be the most popular strategy. This is the one that typically most people look for. This is the one that most people are very familiar with and have a good association with it. The idea of the squeeze play is it looks to get into a trend early on in the trend. That's one of the reasons it's so profitable. When you see those bands contracting, you see that squeeze coming into place, and then that expansion comes in, that new trend is taking hold, you're getting into that trend early on. That's right before the most explosive part of the move. That's why so many people like the squeeze play. One of the things about the squeeze play that you need to know is it anticipates high volatility. What do we mean by that? It's lots of price movement. High volatility means that the price has been contracted, it's not doing a whole lot, and then suddenly, boom, it takes off and it's really doing a lot. Now, that volatility could be bullish volatility, it could be bearish volatility, but the idea here is that the price of the stock is moving a lot, it's moving very quickly. And especially if you're an options trader, that's exactly what you want. Unless you're selling options, pretty much the only way to make money in the market is to buy something and then have the stock move, or to short it and have it move. They're mostly trend trades that we use in the market. And so volatility becomes a real important component of recognizing when those opportunities are going to be showing up. The squeeze play helps to show that, again, because it's anticipating that new trend, shows that contracted volatility, and then it's anticipating that explosive move that's about to take place there. So it's an anticipation of high volatility with high price movement, and usually this portends a new trend, meaning it's the beginning of something new. Now, there's one important bullet point here, and I'm going to underline it in a couple of different ways here. Beware of the head fake. This is the most important thing to recognize. The squeeze play is a great trade setup. It is a wonderful trade setup. And if it were not for the reality that head fakes happen, the squeeze play would be the perfect trade setup. We would never need any other trade setup. But here's the reality. The reality is the squeeze play sets up, and sometimes it does a head fake. And when it does a head fake, if you're not paying attention, you're not prepared for that, you're not aware that this could happen, those are going to be the ones that will really take a toll on your trading account. So be aware of the head fake. We're going to look at it here in just a minute, but be aware of it. This is the Achilles heel of this particular trading strategy. Now, let's talk about some things to remember here. First thing you need to remember, the squeeze itself is the setup. It's the breakout is what you're looking for, is the trigger. A lot of people think when they see the squeeze, you see the squeeze in here? A lot of people think that when that squeeze happens, that they should go ahead and get into a trade. That is not true. What you've got to wait for is you've got to wait for the actual breakout itself. That's going to be the entry for the trade. Now, in this particular one that you see on the screen here, this is actually a head fake. You can see how this worked out here. It broke initially to the downside and immediately turned right around. That's the head fake. And so this would be the bearish entry. And then we immediately get out of the trade, we take on the bullish trade, and then if you were not already in the trade from having recognized the head fake, then you get in up here at the top of the band. That becomes the entry. But it's very important to remember the squeeze itself is just kind of the hey, there's a trade about to happen. It's an alert. It's a trade setup. It's the breakout that is actually the trigger for the trade. You've got to remember that. Otherwise, you'll be jumping into trades, and you don't necessarily know which way you're going. That's another thing you got to remember. These trades can break either way. When you see a squeeze play, it could break bullish, it could break bearish, it could happen either way. So you've got to remember the squeeze can break either way. You can't be biased. Okay, let's talk about some rules that you need to be looking for. The first thing you need to be looking for is a tight bands. You need to be looking for that opportunity when the Bollinger Bands have contracted. Now, sometimes there's question about how you measure the tightness of those bands. And the easiest way you can do it is to use that indicator we looked at a couple of classes ago called the bandwidth indicator. When you pull up that bandwidth indicator on your chart, you can see visually depicted relative to other moves how tight these bands are. And so here's a good rule of thumb. Use the lowest bandwidth reading of the last 6 months. Now, this is not a perfect rule of thumb, but if you go back and you look at the last 6 months, or maybe it's the last 4 months, you can play with this a little bit, kind of customize it to the stocks you're trading or the currencies or whatever it is you're trading and your own trading style. Maybe if you're on a day trading scenario, you may not certainly want to go back 6 months. You may go back the last 6 days or something. But the key here is that you go back and you look and you say, where is the lowest bandwidths? And that's what you're looking for. You're looking to match the lowest bandwidths over a decent sized look back period. If it's a constant squeeze, then it's not the lowest bandwidth. You're sometimes you'll see stocks that are just in a really nice trend or really nice channel, and you kind of have a stable bandwidth. And people often think, well, that's a squeeze. And it's really not a squeeze at all because the stock is kind of stuck there and it's maybe been going in that range for quite some time. You're looking for the outlier. You're looking for the time when the bandwidth has really come to one of its lowest readings in the last look back period. If you're on a daily chart, again, 6 months is kind of a good window to look back and see what those settings are. Enter the breakout after the first closing price outside the band. This is your first rule right here, your first real entry rule. Enter on the first closing price outside the bands. In other words, once the candlesticks close outside the bands, that is actually a signal of strength. One of the big misunderstandings about Bollinger Bands, people often think the top of the band is a sell signal, the bottom of the band is a buy signal. That's not always true. In fact, of these 3 plays we're going to look at today, only one of these plays is going to fall into that category. 2 of these are actually looking for pushes outside the band to signal strength. In the case of a bullish band, the upper band, it's a bullish strength. In the case of the lower band, it's bearish weakness or strength for a bearish trade. But the idea here is just because you're at the upper or the lower band, in and of itself, that does not mean that the trade needs to reverse or needs to go to the other direction here. And so with the squeeze play in particular, you're looking for, on a bullish trade here, you're looking for that first close outside the band, and then you're going to enter on that. Once it's closed, you can jump back into that trade the next day. You could get in on the first day of real strength in the direction of the trade the day after that, or whichever day that happens. A couple ways you can write your own rules to get into it, but the signal here, the trigger, is the first close outside the band. And then once that happens, the trade is on. And then you want to turn around and set a stop. Now, I encourage you, especially with a system that is as quantitative as the Bollinger Bands, I encourage you to set something like a parabolic stop. It's going to be very specific. It doesn't require that you learn to use buffers. It doesn't require that you learn to identify support and resistance or set, based on swings or anything. You can just simply put the parabolic on your chart and track with that. Wherever the parabolic says to set the stop there, trust it. Every day or 2, you need to come back and adjust it. Every day the parabolic will adjust, but you're probably going to have to set your actual broker's settings there. You're going to have to tell them where you want your stop every day. But I really encourage you to use a system like the parabolics for a trade setup like this one right here. Now let's make some observations. Occasionally there's not a closing price outside the bands. Sometimes what happens is the trade gets set up, you have the squeeze, and it starts moving, but it never closes outside the bands. And if you looked at those rules we just looked at, the first rule of entry is to enter after it closes outside the band. Well, what if it never closes outside the band, but the trade starts to expand? Well, here's the way you handle that. Watch for 2 successive days of band expansion and then enter. If you see 2 days back to back, or 2 sessions if you're in an intraday session here, 2 sessions back to back, and the bands are expanding, but you're not outside the band, it's okay. You can go ahead and enter the trade as a squeeze breakout, and just don't expect for the bands or for the price, I should say, to close outside the bands. This happens. It happens relatively frequently. So the key here is wait for 2 days of band expansion and then get into the trade. The tighter the squeeze, another observation here, the tighter the squeeze, usually the more explosive the move. This is not a hard and fast rule, but more often than not, the tighter the squeeze, the bigger the explosive move after it finally breaks out. So those are some interesting observations for you. So let's talk about the head fake. The head fake is the only thing that makes this squeeze play, or I should say keeps the squeeze play from being the perfect trade. Otherwise, everybody would just follow the squeeze play. It's just a perfect trade setup. But the head fake happens. And so here's the important thing is that we learn to identify it. So here's what we're going to look for here. We're going to look for candlestick reversal patterns within 2 to 4 days, or if you're in an intraday chart, 2 to 4 sessions of the squeeze breakout. As soon as it starts to break, if within 2 to 4 candlestick sessions, you start to see a candlestick reversal, for example, morning star reversal, evening star reversal, bullish engulfing, bearish engulfing, harami patterns, anything that starts to tell you, shoot, this trade's reversing, flip your direction. Go the opposite direction here. If you see them, reverse your position. That's why we went over them in class number 3 where we talked about all those candlestick patterns. You've got to learn to identify them and recognize them. Even if you don't know the name, understand what they're telling you because those are your reversal signals. They're really, really powerful with your Bollinger Bands. So when you see them, reverse your position. If you've gotten into a bullish trade, if the squeeze broke bullish, you're going to go into a bearish trade. If the squeeze broke bearish, you're going to go into a bullish trade. Flip your position. Your first target is going to be the opposite side of the bands. So again, let's say you broke into a bullish trade and it starts to have the head fake reversal. You flip your position. Your first target's the lower band. If you broke into a bearish trade, you have the reversal. You flip your position. Your first target's the upper band. That's going to be your first target. Now I say it's the first target because there may be more. Oftentimes, what happens is the trend will form in the opposite direction of the initial break. So let's say it started to break bearish, gives you the head fake, it'll trade right back to the upper band, and oftentimes will continue with a bullish trade. So the upper band would be your first target, but maybe not your ultimate target if the trend starts to continue. What I want to do here is let's look at several examples, then we'll do some back trading. So let's take a look at a couple of squeeze examples here, and then we'll get into some back trading, and we'll actually work through the squeeze play setups here. But take a look at this chart of the Dow. Notice how the squeeze started to come into contraction here. Now, it's very visible from the Bollinger Bands, and it's also very identifiable from the bandwidth indicator here. If you look back several months, you don't see any bandwidth indications that are this low. And so you know this is a squeeze. You know that the probabilities are very high that when this breaks, it's going to be an explosive move, and it's probably going to establish at least a good-sized swing, if not a full-blown trend in a direction. Now, you don't necessarily know which direction. In this case, it broke bearish here. Let's look for the signals we were looking for. We said a close outside the band, and we got that right there. So your entry would be the next day, where it just continues in that direction. You're also going to notice with your percent B, you're oversold. You're always going to be oversold on a squeeze breakout like this. If it's a bearish breakout, if it's a bullish breakout, you'd be overbought. But with this one, it's bearish, so it's going to be oversold. The reason, remember, percent B tells you where you are relative to the band. So if you're oversold, if you're beyond 0 in this case, you know you're below the band. If you're above 1, you know you're above the band. So it's going to be looking like it's extremely overbought. Most people think that that's a reason to, in this case, buy it, but it's actually the opposite. It's a signal of bearish weakness or bearish, strength into the bearish trade here. And so you want to be selling that, either selling it short, buying puts, doing something to trigger into the bearish trade here. So there's your first example of the squeeze and everything else working with it here. Look on the right side of the chart. You're going to see the same kind of setup here. The squeeze visually, very obvious on the Bollingers itself. The bandwidth indication is very low. Look back several months here. The previous one was about 6 months before. That's the one we had just looked at. And of course, again, you're very oversold in your percent B. You had the first close below the bands here. You entered the trade the next day. And, here we were, 7 or 8 days later, 700, 800 points to the downside on the Dow Jones Industrial Average. So there's a couple of examples. Let's look at some more. Let's look at one here on First Solar. Again, another bearish trade example. You see we had the squeeze set up right here, very visually obvious on the bands. You look at your band width, very low reading. And if you look at your percent B, of course, you're extremely oversold because you're pushing outside the bands there. You have the close outside the band. Now, this one is a little different, but it's very typical. You actually had several trading sessions here, 1, 2, 3, 4, 5, 6 sessions before it really started making bearish progress. So you actually had about 6 opportunities to enter this trade and not lose any of your real profit. Now, this could scare some people. Some people might start to think, well, the trade is not going to work. You need to go with it, set your parabolic stop in there, and trust it until you see the head fake, until you have a reason to not take it. Trust the trade and just go with it. And, of course, it did come up here and eventually broke on bearish. We ended up getting in this trade about, $67 a share. And where you started getting your exit signals were down here around $50 a share. So that's a $15 to $17 per share profit in just a couple of weeks. Very, very quick trade there with First Solar. Now, I've not got it marked on the chart, but I do have another one over here as well. This one, take a look at this squeeze here in February. The bandwidth was not as low, so it was a lower probability squeeze, but it still worked out just perfect. You see your bandwidth is low, but relatively speaking, it is not as low as it was in September. So September was a higher probability break than the February squeeze here. Sometimes the February squeeze, if you look back here, you can see that one had been going on for about a month or so, maybe more. And so this one was actually lower probability because the bandwidth was not as low. And that's what I was trying to say in the last video, where sometimes the bandwidth contracts, but it's not a squeeze. Here, it was kind of the same setup here. It was contracting, but it wasn't nearly as tight as the one in September. It did still play out, but it took a little bit more time. Look at what happened. We had our first close outside the bands. The next day, we had a solid close outside the band. Bandwidth starts to go up. You're extremely overbought now, and the bandwidth continues to go higher. And as you watch this bandwidth going higher, it's interesting because we traded sideways for 4 sessions before we got another bullish candle there. But the whole time the bandwidth was going higher, telling you the volatility is going up. And so there's still strength in this trade. And then eventually the surge came in here and eventually it gapped on out. And again, it became a pretty good profitable trade on First Solar here. So there's a couple more examples here. Now let me show you a head fake example on Halliburton. The scaling on this one's a little bit off. Just simply because we had about a 50% drop in the stock. If you come to the left side of the chart, you see very, very low bandwidth back here in September coming into October. And the bands had actually started to expand before we got the squeeze set up here. But you start to see the closes outside the band here. I don't have the %B on here, so you can't see that. But you still see the closes outside the band. And then once this move started moving, it was a $65 move down to about $50. So there's about $15 per share move. But that's not the one I wanted to show you. The one I wanted to show you is the head fake on the right side over here. You see the squeeze? You see the close outside the bands. Now notice the weakness that's in here. These are very small candles, so it's not really strong momentum at this point. You've also started to establish a base. If you look here, you can see we're establishing some support. And as we get back down to that level, we've got a bullish engulfing candle. It's just 4 days after we broke and closed below the band. And so when you see that right there, in this case it was exactly 4 days. Usually it's within 2 to 4 days, occasionally 5 days, but usually within 2 to 4 days, there's your head fake right there. You're starting to break bearish. Instead, it gave you a bullish engulfing formation. Buy the trade. You end up getting in to the stock about $40, maybe $41. You set your stop about $39. And so you got about $1.50 to $2 risk. And then your target up here became about $45. And in fact, the trade went a lot further than that. But that became a pretty good 2 or 3 to 1 risk-reward trade. And most head fakes work out like this. So there's a couple of examples of both the squeezes and the head fake to kind of get you going in the right direction. Before we get into the back trading and the squeeze play, let's talk about the target component here. The target is a really important component of our plan. Unfortunately, with the squeeze play, it's not always that obvious. So how do we deal with it? Well, often with the squeeze, you don't know exactly where the target is. There's a couple things we can do. We can estimate based on support and resistance. So what you do is you look back, even though we tend to kind of leave line drawing out of the Bollinger system, you can look back and look for your previous support level, previous resistance levels. Those become probable targets moving forward. You could bring in another discipline, such as your Fibonacci trades or whatever, and add some additional structure to give yourself some targets, but it's kind of somewhat defeating of the way that the Bollinger system is. So the best thing to do is to go with the trade almost blindly. And I hate to do that. I'm like, I always slap myself when I think that. But when you see the squeeze play, there's a certain part of you that just has to have faith that there's going to be a lot of explosive moves here. If there's an obvious resistance coming up, you think about that as a target. If there's an obvious gap or something in the way there, you can think about that as a target. But otherwise, what you're really watching for is you're watching for the candlestick reversal signal. Watching for the candlestick reversal, that is going to be your key to getting out of the trades. And of course, don't be afraid to stop out. I am going to trust you that you're getting into these trades with a stop. Now, I suggest for simplicity purpose that you use something like the parabolic stop. That's going to give you a very good place to set an adjusting stop that will trail along with you. You're going to have to adjust it every day unless you've got a trading program that will track and adjust for you, the parabolic. But it still gives you a really good place to set your stop, and you're not sitting there second guessing. But if you don't want to trust the parabolic, I'm going to have to trust you that you're going to use a stop, and you can't be afraid to stop out of the trade, because very often this is what's going to happen to you. But more often than not, if you do the squeeze play breakout, you'll get out when you start to see the exit reversal candlestick signals, and you'll just trust your stop. More often than not, over time, this will be a profitable trading system for you. So what I want to do now as we get into the next video is I want to start doing some back trading. We're going to go actually look at some squeeze plays. We'll look at breakouts that worked well. We'll look at false head fake breakouts, and we'll talk about setting the stops and all the setups here in the next video. Okay, what we're going to do now is we're going to actually get over here into our charting software, and we're going to do a little bit of what we call trader conditioning. Some people refer to it as historical replay. Some people refer to it as back trading. It's all talking about the same thing. And the principle here is that we're going to go back in time and we're going to trade through some historical moments of a stock. Now, if you're not familiar with this concept, I want to point you over towards the Foundations of Stocks and Options, Level 3, Class number 1 and number 2. Foundations of Stocks and Options, Level 3, Class 1 and 2. That's where we teach the trader conditioning process more in its entirety. So what we're going to do here is we're going to get over into our charting software, and I've already pulled up a ticker symbol. It is ticker symbol GMCR. That is for Green Mountain Coffee Roasters. And, of course, they roast coffee. And what we're going to do is we're going to go back in time using the replay tool. And if you look at the bottom of the screen, you're going to notice it is September 2012. And we've got a squeeze that is coming into play here. So remember, the squeeze is not the trigger. The squeeze is the setup. The squeeze is the setup. So this is coming into us. It's not yet triggered an active trade. So what we want to do, let's zoom in just a little bit. And we're going to wait until this trigger actually moves us into the move. So the first day, nothing happens. The next trading day, nothing happens. The third day, we get a little move the other direction, but nothing really. And there it is. It's on the next trading day that we finally get the trigger. So here's what happened. We move outside the band. You see how we're up? We're closing outside the band. That is the trigger that says this trade is going to be on. Now, what we want to do is we want to enter the trade tomorrow just above today's candlestick. So that's going to put us about, $27.90. If you want to loosen it up, you could be up there at $28 or so. But just above today's trading session, that will be our bullish entry. And then, of course, we've got our stop down here. That'll be your parabolic stop. Now, most of your brokers are not going to automatically put a parabolic stop in. You're going to have to identify where the stop should be, in this case, 23.12. And you will need to adjust it yourself and set that. For most brokers, some brokers have a parabolic stop system built in. Most of them do not. All right, so what we want to do now is let's see if tomorrow we get triggered into the trade, and the next day, boom, there it is. So you can write this down. We're in the trade at $27.92. Now we're looking for two things. Number one is a reversal signal. This is typically going to be your exit right here. Number two is if the trade actually reverses and we stop out. Okay, now I prefer number one. I would prefer to see the reversal and get out. That's going to maximize your profit. If you know where a target zone is, then that also is a possibility. If you need to look to the left to find a target, then you can do so. I don't know that there's one on this chart because we're already trading up into some gap territory. We'd probably have to go way back here into history to find anything. And, that's probably not the best use of our time. And it's not really the way the Bollinger system is built. The Bollinger system does not require that we've already got some support and resistance drawn. It just requires that you recognize the reversals when they're happening. So we've got our trade set up here. We've got our entry at 27.92. We've got our stop at 23.44. It's going to be the red number over here on the right, 23.44. And let's go forward today and see what happens. So the next trading session, a little gap up. We are closing the day at 31.71. So this trade is now a good trade. It's a good bullish trade. Let's see what happens the next trading session. And boom, there is a little black candle. Now this 2-day pattern creates a bearish engulfing candle. If you want to, you've got two choices that you can make. If you want, you can set a stop at the low of the bearish engulfing candle, and you'll probably get out of the trade tomorrow. To be completely honest, that's probably what will happen. It might open up and continue bullish. That could happen, but you realize you've been outside the bands for 4 days back to back. This trade is a little bit overextended. Your percent B is starting to head down. Most likely this trade is going to start going sideways here. And if you're in an option trade, you definitely want to be getting out of the trade. If you're in a stock trade, you could hold it a little bit and see what happens. You could leave your stop in here with a parabolic. It has gotten a little tighter. It's now at 24.66. So those are your two options. Set your stop really tight right at the low for the day, or keep tracking with the parabolic. If you wanted to, I guess you could put it up here with the 20 period. Lock in a little bit more, but either way, if it goes that low, you're going to be losing money, and you got a perfectly good trade at this point. You've got a couple of dollars of profit. Remember, we entered at $27.92. We're up currently at $30.44. So if you just close it right now, you've got a profitable trade. And what do they say? A bird in the hand is better than two in the bush, right? So we've got a bird in the hand here. So let's see what happens the next trading session. And oops, I ran it forward a little bit extra there. The next trading session, we actually would not have stopped out of the trade, very close to it. Maybe we did stop out by one tick, but it's pretty close. I think you're still in this trade here. The following trading session, let's see what happened if we were in it for one more day. Well, it's looking a little tempting here. It looks like we might still slightly be in this trade, ever so slightly. Let me just go ahead and put a visual stop in there. We'll go ahead and snug it up there about $29.93. That'll be nice. That'll be a nice $2 profit exactly if we get stopped out. Now, it may continue. And notice that now it's inside the band. Look at your bandwidth or your percent B. Notice we're inside the band here. So that's actually good. It's a good possibility to start walking the band. That's about where that would happen. The fact, though, that we had this bearish engulfing pattern, that's what concerns me on this trade right now. So let's see what happens as we move forward. And another sideways day. And the next day, we get stopped out of the trade at $29.93. So we actually made $2 per share profit on this trade, assuming that you used this tightening of the stop method. You do that when you see the candlestick reversals. If you don't see the candlestick reversals, you can stick with the parabolic. Now, if you stuck with the parabolic, you're still in this trade. So let's just see where that plays out, just in case you were sitting there thinking you're going to stay with the parabolic. And another trading session or two more trading sessions, and it looks like you're going to be stopping out on the next trading session here. So you would have gotten out about 27.20, and you would have actually ended up with a little bit of a loss. So this is a really good point. This is why we do the trader conditioning process. Let's just stop here and let's analyze what has happened. So first of all, notice we got the signal on the squeeze break. We entered the second day. It was a profitable trade. The trade moved up nicely. Then we got the exit signal. The exit signal were the candlesticks. This is almost always going to be your case. More often than not, a candlestick reversal signal is the time to get out of a Bollinger trade more often than not. Bollinger squeeze trade here. So at the end of that signal, what do? We tightened our stop up here to $29.93. That gave us almost exactly $2 of profit. If you had left your stop and you kept tracking with the parabolic, you would have ended up getting out of the trade for a loss, actually, even though it was a perfectly good trade.
And so this is one of the reasons we do this trader conditioning, back testing stuff, so that we can see how these trades set up and we can learn from them. So whichever way you set your stop, this was a learning opportunity. The way I chose to set it, which is usually the way I'll do it, is I'll set the initial parabolic stop, and then once I see that candlestick reversal, I get out of the trade. Let's move this thing forward and see what happens. If you trade it sideways for a little bit here, or move it forward, I should say, we're going to start to see the bulge created. Notice how far down this came, by the way. That candle reversal, actually had a pretty sizable move to the downside, almost $10. Went from $32 down here to $22. So that's a $10 move to the downside, and that would have worked a little bit like the reversal play that we'll talk about later. So let's keep moving it here. At some point, another squeeze will get set up, so I'm just going to move it forward very quickly, and there's a squeeze starting to come into play. So let's go through another one of these and see how this one plays out. So there's your squeeze starting to set up. Your bandwidth is low. It's not quite the lowest of the last 6 months, okay? Take a look at this. Let me zoom out. Remember, we like to find these bandwidths that are the lowest of the last 6 months. Now, this is a pretty low bandwidth, but if we come further back here, let me use a crosshair tool so you can really see the line. If we go a little bit further, you notice that the lowest one was the one that we just traded, the one from September. And this one, while it is low, is not quite as low. September's the winner, and then this one's pretty low. And this is certainly a squeeze. I mean, the squeeze play is on. It's just not quite as tight. And historically, the tighter the squeeze, the bigger the more explosive the move. So let's see what happens here. Let's just move this trade forward until we get the trigger. Now, right now we've got the setup, but it's not triggered. Remember, we trigger when we close outside the band. So the next trading sessions, what's happening, moving it forward here. Just keep moving it forward. And one of these, there it is right there. Okay, so we're going to enter the trade. Now, this one's a little different. Notice it's got a long upper shadow. Okay, so that long upper shadow is, I don't really want to set an entry way up here at $28 when I'm $2 away. So I'm probably going to set that entry just a little bit above the closing price, maybe a little bit of buffer in there, maybe about 26.36 or so, just a little buffer, 20 or 30 cents. It depends based on the price of your stock. There's no hard and fast black and white rule for this, but we'll set the entry trigger there about 26.36, and we can already see this is probably going to get triggered the next day. What happens? Nope, turns out we did not. Look at that. By the way, that's why we do entry triggers. The reason we do entry triggers is so that we avoid bad trades like that. You give yourself a little buffer. A lot of people would just jump right in. A lot of people go over that first day, they see it moving outside, and they say, enter the trade. It's always the second day, and give yourself a little buffer there. Make sure that we're not going to do what we just did here. Now, it may still trigger the next day or two, or we may get a reversal. Let's see what happens here. On the next trading session, it actually is coming down. Okay, so let's stop. Let's reanalyze this thing. Notice we got the breakout of the squeeze. This is not really a candlestick reversal signal. It's so close, but it's really not one. If it was a evening star reversal, if this was a good-sized candle, then I would say, short this thing, and we're going straight to the lower band here, and we got a decent little risk-reward. In that case, we'd have probably about a $3 or $4 reward for that trade. In this case, there's a lack of strength for the bearish trade. It's just starting to look a little lackadaisical. Let's go forward one more day, see if there's any more signals. There's really not. A bunch of little spinning tops here. And what happens the next day. A little spinning top. This is very non-committal. And you can see it's just, the bandwidth is coming up. Percent B is coming down. This is just starting to become a trade that doesn't have a lot of definition to it, and you don't want to get into that kind of a trade. Now, there's a solid bearish candle, but it's a little late. At this point, if we got into this trade, we would be getting in around $23.50 or so, and our target's down here at $21. You could do that, but it's not got the same charm as if this had happened, a few days earlier. This most likely is going to continue moving sideways in a very, kind of lazy motion here. So this is not a good trade. Probably want to avoid that. There it's sliding down a little bit. And there's a little bullish candle. This is actually, it looks like another squeeze is coming in. That's what's going to happen here. Okay. So watch this. You see the squeezes coming in. Now, this is worth noting. This was not profitable too much, but it's worth noting. Notice after we had that little move outside the bands and then it started to come back, eventually it worked its way almost back to the lower band. It's just that it ended up not being a very profitable move. You could have shorted that and still made some money, but wouldn't have been an overly profitable move. So now what's happened is we've got another setup here. Again, we don't want to blindly take this trade. We just want to wait until the trigger. The trigger is going to be closed outside the band. Let's just move it forward one more day and see what happens here. And, there it is. Okay, so there's our entry signal. This is going to, notice we got the close outside the band here, and this is going to happen on 11/19/2012. So just for a date reference there. So what we've got is we got our close outside the band. What we want to do is we want to set a trigger, an entry trigger, to get into this trade if the trade keeps going higher, about 27.33. Again, just above the close of the day here is typically a good rule of thumb. And normally the next morning it will move straight up here and you'll trigger into the trade. Now, of course, this could reverse against us, but let's see what happens here on the next trading day. And looks like there's a huge gap up. Okay, so let's talk about this. There's a couple ways you could play this. One, if you set a blind entry, if you say, if I am at 27.33 or above, then buy. If your contingency order says that, then you got into this trade up here at $30 a share at the opening of the day. If you had a limit order, then you didn't get into the trade at all. You can see you're not actually in this trade. Now, this candlestick formation is a little bit goofy, and this is actually somewhat problematic. It's still bullish, believe it or not, but it's somewhat problematic because we've gapped up here and we've traded down. Now, this looks like a bearish counterattack, and it's got a lot of that candle formation to it, but notice we still got a gap here, and until that gap's really filled, this is a bullish trade, believe it or not. So let's see what happens the next trading session here. The next trading session, we could have gotten filled at our trigger point here, 27.33. It looks like the gap almost filled, but still didn't quite fill here. So, I'll leave it up to you if you want to get into this trade or not. It kind of can go either way. You've got some candlesticks here looking a little scary. Maybe don't want to jump into it. I'm not quite ready to go to a bearish trade. It might turn into a false breakout. This is what false breakouts often look like, but sometimes, it moves positively here. And so, believe it or not, we're actually getting little black candles that are moving higher. Now, that's not usually a picture I want to be moving into. I'm still not sold that I want to buy into this picture. You might want to. It's moving in the right direction, believe it or not, ever so slowly. But I would like better confirmation. What I do have that's working in our favor is our bandwidth is increasing. But our percent B is coming down, that's normal. We would expect that. I'd almost kind of like to see this come in here to a 20 period and then continue, almost maybe letting this become a trend trade. Let's go one more candle and see what happens. See, now we're getting the momentum a little bit. We're getting some white candles. This could easily turn into a walking the band. Now, if you wanted to enter right now, you could. If you have not done so already, you could have entered on this day here. This is a bit of a gray area because you see what's happened here. We've got the breakout. We got the breakout on the squeeze. That's what you would expect. The second day when you want to get into it, we actually had a bearish candle, which puts a lot of fear into you. And so this is a gray setup. It's turning into a bullish trade, but it's not the kind that you're really confident in at first. I actually think this is going to play out for us here. We'll see how this goes. But in the real world, I'm not sure I would have done this. I probably would have already moved on. Let's see what happens next. Little shooting star candle. I'm probably out of this trade, to be honest. If I got into it, I'm probably out at this point. This just it reeks too much of a false breakout, and I'm not going to go with it. So that's what I would do here. Depending on if you got into it at all or where you got in, that would determine your actual profit. Here we're at 28.55, so maybe you have a $1 profit, or maybe you just didn't get into the trade. Let's see what happens out of curiosity. And there it is. So Go figure. Huge gap outside the band. And, it's probably continued moving from there. So how would you have known? You would not have known. This is a great conditioning exercise right here. People, they'll often go through a trade like this. They'll say, how could I have known? I can't believe I missed the big trade. Well, you wouldn't have known. You had no way of knowing this was going to, jump 3 standard deviations away or whatever it is there. You had no way of knowing that was going to happen. And so what we're trying to do is we're trying to do predictable trades. This is an outlier. This is a windfall profit. And yeah, it would have been great to have gotten in at 27.33 and gap up to 36. That would be great, but it's not very predictable. And this is probably going to reverse on us here. In fact, let's just watch it out here while we finish this section off and just see what happens. Usually after you gap this far out of the band, you would want to start taking your profit. Just simply because it's about to reverse on you. Usually it's going to come back in. Let's see what happens here. Here, just talking about candlesticks, you've actually got a harami pattern, a little bearish harami. Let's just move it forward a couple sessions, and it looks like we're getting back inside the band, but making a little bit higher move there and starting to walk the band there. So, this is interesting. Oh, there we go. There's the evening star reversal. That would be your exit signal. Were you to have entered back here and have traded this up, there's your exit signal right there. Get out about $37. Now, I didn't like this trade setup. I personally would probably have not had the courage to do this trade setup. Maybe I should have. It would have worked well. You would have made $10 a share had you done it. But, I didn't like the candlesticks here, and that's why I didn't do it. If you had done it, let me teach you this principle. If you had done it, you want to get out right here in the evening star reversal. That's going to be the end of the move. You see the bandwidth is coming down. That's definitely the end of this swing here. Plus, you've also got the divergence happening with your percent B. Notice stocks going higher, percent B is coming in. So this trade is going to be done at this point. But that's how I would have traded through that. This is a conditioning exercise so you can see what it would look like. Hopefully it's been beneficial for you. I'll just run it forward so we can see where it goes. You can see it's moving sideways, and it looks like we're getting into a trend trade here. So you could re-enter the trade as it starts to move higher if this happens. Let's see, because right now it's not moving higher at all. You notice the percent B continues to get weaker here. This is pulling away from the band. Usually those are exit signals. If it starts making higher highs, it turns into a trend trade typically, but we're not doing that right now. This is very much sideways. Now, if you were in an option trade, that's obviously your exit signal. An option trade, you just wasted about 3 weeks of nothingness. So your premium is just eroding away here. And it looks like another squeeze is going to be setting up here in just a little bit of time. So that was your exit signal. Had you traded this through that, again, I don't think I would have entered this trade because of that candlestick formation right there. I don't think I would have had the courage to get into it. Had you had the courage, you could have made some windfall profit there. And then, of course, the evening star reversal was your exit. So this is one example of trading a squeeze, and hopefully this is beneficial for you. We went through a couple of setups there. Okay, so I want to do another squeeze play setup here. So I've found one here on Home Depot that I want to show you. And you see the squeeze is starting to get set up. Bandwidth is the lowest it's been in the last several months. We can zoom out a little bit, and you can see it's actually definitely the by a long shot, it's the lowest that we've had in the last 6 months or more. And so even the previous lowest bandwidth were lower than that. So it's a very tight squeeze. So you have a pretty good idea this is going to be a relatively explosive move when this happens. So again, this is the setup. This is not the trigger. This is the setup. So we're watching for a move outside of the band. Okay, so we're moving a little bit inside the bands. It can do this for quite some time. So let's go forward a couple more trading sessions here. And boom, there's our first move outside the band. Now this is the lower band. So what we're going to do is we're going to set a trigger in here just below that price point as an entry point here. So I'm going to snug it up just a little bit more here. I think I am. There we go. Snug it up to about $11.08, and this will become our entry. So let's move it forward a day here, and you can see this is going to trigger. There it is, $11.08. Now, you happen to see I have some support and resistance lines in here. They came on whenever I turned the triggers on, so we see those, what I had hidden in here. So we're going to know that there's going to be a target down here about 107, only because I've got my support and resistance in here. If we didn't have it, then we're just simply looking for the candlestick signal to get out of this trade. So, and of course our parabolic is up here. That's setting our stop. You see the parabolic right there. That's showing us where our stop is, and it's just going to be adjusting down every day that the trade moves. So the next trading day, we're well outside the band. So now we're starting to get some profit here. And boom, there's a big move right on down. And now notice where this stopped. Since I've got the support and resistance in here, just take note here, that's where it stopped, right at the support level. And of course, we're way outside the bands at this point, so our percent B is way down here. Now we're going to start watching for a divergence in your percent B, and of course, any candle reversals. That's really the signal we're looking for. And there's the big one right there. Look at that. So this is what I'm wanting to draw your attention to. This was an explosive move, and we traded right to a support level here. And look at the candle reversal. It happened very quickly, bullish engulfing right at support, pulling us right back inside the bands there. That's really your exit signal. And so you're going to want to get out of this trade pretty quickly. If not immediately here, then certainly at the beginning of the next day. And we'll watch where this goes the next day. Boom, you're out of the trade. Now, why did I pull this example? I wanted to pull this example for a couple of reasons. Number one, I wanted to show a bearish setup for you. I also wanted to show you the importance again of the reversal signal from your candlesticks. That is the signal. Now, the next thing that I want to show you, I didn't intend to turn the support and resistance lines on, but since I did accidentally, this is a perfect picture of what I really use. In my personal trading, I will tend to use these Bollinger Bands with my other tools. That's when I really like them. And so I see the squeeze set up, I see it coming, and when it trades to that support level and I start to move the opposite direction at all, that's an exit signal for me. That gets me out of the trade. That's what I'm looking for. Just so you can see where this trade went, a couple days later it did come back in and we started to just kind of establish the support there. And then it ended up moving on up higher again. So those were definitely the exit signals. That's what I wanted to show you, and that was the purpose for bringing in this example here. Okay, for this video, I've pulled up another squeeze play, and this time we've pulled it up on Chipotle Mexican Grill. So that's ticker symbol CMG, Chipotle Mexican Grill. And you're going to notice that the setup has come to us. It's sitting right here staring us in the face saying, yep, I'm ready to break one way or the other. Now, which way is this thing going to break? If you look at the history here, we've really been moving pretty much sideways for the last several months. But we've had some volatility. And so we're looking for either a break bearish or a break bullish. We really don't know at this point. Now, what we are watching for is a close outside the band, so let's move it forward a couple days and see when this close happens here. So it's going to not be there. The bands are getting very small, certainly one of the lowest levels we've had. And the next trading session, we actually just barely have it closed. If you can even see it, we actually closed just outside of the bands. And you can see it actually better on the percent B, the fact that we are actually below the zero reading here. So you could put an entry here as a bearish trade. And in this case, I'm going to give it just a scotch more room. Not much, but a little bit scotch, right about the low of the day, about 644.80 will be our bearish entry on this trade. And of course, we're going to start off with a parabolic stop in here, and we're watching for an exit signal. Now, watch this trade, and let's move forward. The next trading session, there's your explosive move. So you're into the move at 644.80. And in one day, in this case, it's a $600 stock. So in one day, you're up. In this case, the stock's down $11. So you got $11 of profit in that trade. Now let's move it forward another day. And whoa, stop. All right. This is your immediate candlestick reversal signal within 2 to 4 trading sessions. So what do you do if you see an immediate candlestick reversal? In this case, it's a tweezer bottom type of a formation. We pushed outside the band. We immediately turned around and pushed inside. What do? We switch our trade. So what we're going to do here is if this trade goes any higher, the high of the day is 651.58, we do a simultaneous switch. So at 651.58, we sell to close any puts that we've got, and we buy a call. Or if you're got into a short trade, then you buy to cover any short trades you've got, and then you buy additional shares at 651.58. Now, our target on this trade is going to be the upper band whenever we connect with that. And your stop on this trade, I'll go ahead and use another little signal here for that. We'll use the bottom of the day. So this case, you got an expensive stock. In this case, you've got a $651 stock. So that's a large stop that we've got there of about $16. Now let's move this thing forward and see what happens. The next day, boom, we immediately traded on up and triggered, and we're into a switch stop scenario where you immediately switch your direction at 651.58. So we're now into a bullish trade, and this is what I'm wanting to show you. This is the head fake right here. So let's see where this thing goes from here. Next day, it's a little bit of a sideways move. The next trading session, explosive move up to 667. And so that is your minimum objective. That is your target. You can now take your profit on that trade. So you ended up losing some money on this trade. You lost from 644 as it went up to 651. So, whatever I'm not going to mess with the pennies on that thing there, but you lost about $7 on that trade. And then if you closed it out now at 667, 667 having entered at 651, that gets you $16. So you lost 7, you gained 16. That was about a 1-to-1 risk-reward ratio for that portion of the trade. Now, you could also stay with this trade until you have an exit signal. So let's see when the exit signal comes. Let's watch this thing a little bit here. And if you stay with the trade, and a lot of times on the switcheroo here, when you have the head fake, a lot of times, at least half the time, this turns into a trend in the other direction. So watch here. If we've just stayed with this now for 4 days and we're already up to 678, let's see where it goes from here. Boom, there's a huge explosive move on the opposite side up to 692. And let's go until we have an exit. There is a bearish harami. Okay, so if you stayed with this trade, bearish harami is at 684. I would probably recommend taking your profit at that point. If you got in at 651 to 684, that's a $33 profit, so that's pretty good right there. Just for the sake of seeing where the trade goes, I'll go ahead and run it forward for you here. Another little bearish candle, a little shooting star, and that's the we're up to the beginning of the year on that trade there. If we wanted to keep running it forward, here's what happened and eventually retraced there. So the bearish harami is the exit signal. And again, this is about 9 times out of 10 going to be the way that these Bollinger swing trades, these Bollinger squeeze trades terminate. You're going to see a little candlestick pattern such as that right there, the bearish harami, a bearish engulfing, you name it, any of the patterns, those end up being the exit signals to get out of that little explosive move. And in this case, had you done that trade the way that we just talked about it, you could have pulled off at least a $16 profit, and you could have pulled off as much as about a $33 profit, depending on exactly how you entered and exited the trade. But that's a false break. That's the head fake trade there for the squeeze, and I really wanted to show you an example of that, walk through it so we could see how it emerges. It starts off looking so confidently, in this case a bearish trade, but immediately 2 sessions later, we got a tweezer bottom. We switch the trade around. We go the exact opposite way. Trade to the upper band is your minimum objective, or you trade till you get an exit signal. And had you traded the upper band, you got a $16 profit. If you traded to the upper signal here, or to the exit signal, I should say, you had about a $33 profit on that trade. So that is a perfect example of the head fake trade.
Now let's talk about play number 2. It's the trend trade. The trend trade is the holy grail of traders. Everybody wants to get into the beginning of a trend, get out right at the top. That's what the perfect trade always looks like. So the Bollingers are pretty cool because they give us an interesting framework to track with those trends. So here's what it's going to look like. First of all, you need to know the trend trade is actually really similar to a squeeze play. It's going to show strength when you're pushing outside the band, not showing weakness there. But the difference is the trend trade, at least at the beginning, is not going to have the squeeze. Now, sometimes you actually have a squeeze play that develops into a trend trade. In fact, quite often that happens. But at the beginning of a trend trade, sometimes you don't have the squeeze to confirm that this thing is getting ready to explode on you, and yet the explosion is about to happen anyway. So it's similar to squeeze, but without the squeeze. Here's the idea. We're going to be buying at the upper band into strength or selling at the lower band into weakness. So it's the same principles as what we just looked at with the squeeze play. And you need to know that the trend trade is really going to be the most consistent and the most reliable when you pair it up with other indicators and other analysis. So we're going to use our %B. The bandwidth is probably not going to help you as much with this particular trade setup, but you can also go out and look at your stochastics indicator, your RSI, some of your other indicators that you've learned to work with, and of course, as always, work with your stop in this trade. Again, I suggest the parabolic stop. Kind of across the board for all Bollinger trades, if you're just using the Bollinger system, I suggest the parabolic is a great place to set your stop. Let's look at some trading rules here. For a bullish trade setup, here's what we're looking for. We're looking for stocks with strength. You say, how do I know that it's got strength? Well, look at your other indicators. If you've got strength in some other indicators, if you've got pattern breaks somewhere else, let's say you've got a rectangle pattern that's breaking, or you got another type of a pattern that's breaking, and you recognize that, and you look over at your Bollinger Bands and you see this trend trade setting up, those are good ideas. Volume, if you see volume strength coming in, that's always a good idea. Breadth indications. Fundamentals. This is actually a really, really great play for fundamental traders who want to add some technicals into the mix. To go find stocks that have a lot of strength fundamentally speaking, and then they get the right setup or the right picture here with the Bollingers, that's almost always a good indication of when you should get into the trade. So it can be the right fundamentals strength-wise. It could be the right fundamentals weakness-wise if you're looking for a short trade or for a bearish trade. Buy on the touch of the upper band. This is what you're looking for here. If you look at this picture I've got on the screen, this is where the trade's starting to take place right here. We touched the upper band, we pulled back for 2 days, and then we pushed right outside. That is your buy signal. That's where you want to start getting into this trade. And what you're going to notice is oftentimes it'll walk up the band, it'll pull back to about the 20 period, it'll keep walking and pull back. And these trend trades will just keep going. Sometimes they'll go for 4, 5, 6 pushes to a high, and they just keep going higher and higher. Or in the case of a bearish trade, keep going lower and lower. But again, we're looking for stocks with strength. Buy on the touch of the upper band. And again, set your stop. I will just say this over and over. You got to set your stop. And again, to keep it simple, I suggest a parabolic stop. Now, if we want to look at the bearish rules, they're exactly the same, just inverted. Look for stocks with weakness. You can define that weakness with other indicators based on any of your indicators, your pattern breaks, volume, breadth indicators, and of course fundamentals. Again, if you look at your fundamentals and you see this company just has horrible fundamentals and we start to see that move into the lower band, that's going to be a short opportunity. So short on a touch of the lower band, and again, turn around and set your stop. It is so important that you do this setting of the stop. Now let me give you some general observations regarding the trend trade. First of all, you can buy or short retracements back to the middle band. I've already mentioned this, but let me just kind of draw it out on the screen for you. It's so important. When you see the trend trade, it pushes up to the upper band. Let's say that there's your upper band right there, and let's say you've got a middle band in here. Okay, when it pushes into the upper band, it'll probably walk the band, and then it will pull back, and then it will continue. On those little pullbacks right there, you need to be buying. Or if it's the case of a bearish trade, it's just going to invert just a little bit here. Let me see if I can draw this clean enough on the screen here. What will happen is in the case of a bearish trade, it's pushing down into the lower band, and it will bounce, And when you get to that middle band, short it again. Those are re-entries. It's the same principle you're used to working with for years. Buy on the dip or short on the bounce. It's the exact same principle. We just have it here contained inside the bands. And in a bullish trend trade, it's going to be between the upper and the middle band. In a bearish trend trade, it's going to be between the lower and the middle band. But either way, that middle band is the key. So remember, you can buy or short the retracements back to the middle band. Also, you need to know this method is very good when other confirmations are present. For example, other indicators are working with you, your stochastics, your RSI, any of the other indicators that you're used to working with. This particular system, this method of trading the bands works really well with the other confirmations. And then as I've already mentioned here, fundamentals. If you're a fundamental trader, and a lot of you are, you're looking for additional technical confirmations for your fundamental analysis, this is a great setup here. You do your analysis when you see the strength in the fundamentals, and then you touch the upper band, you buy. When you see the weakness in the fundamentals, you touch the lower band, you start shorting. It's a great trade setup for you. Now let me give you a couple of additional observations when it's specifically related to percent B. If percent B is over 0.8 or it's below 0.2, this is going to be a good start of recognizing that there's strength or weakness. Of course, above 0.8 would be indicating some strength. Below 0.2 would be indicating weakness. Again, it's going to be ideal if you blend in some of that additional analysis, whatever your techniques are, be it fundamentals or other skills that you bring in there. And then when you have prices that push outside the band, this is really important, really important. Prices pushing outside the band in the trend trade are actually continuation signals. A lot of people think that pushes outside the band are signals that we're too far from the standard deviation, this thing is done. But no, it's actually the opposite. In the trend trade, pushes outside the band are actually strength signals. They're going to be continuation signals, and that's where you start to see the walking the band. And in these trend trades, what's going to happen in a bullish trade, it'll start pushing up into the band, and it'll keep walking along the band, retrace about to the 20 period, push back up into the band. In the bearish trade, it'll push down into the lower band, bounce up to the 20 period, push back into the lower band. It'll keep pushing along. And the more it starts to push outside there, you know, the stronger that move is happening. Now, that's going to happen quickly. It's not going to stay there forever. You're going to recognize your percent B will be extremely overbought or oversold. Won't happen forever, but it's a really good sign of strength, and you don't need to be afraid of that, especially if you're anticipating the trend trade specifically. This last point here, prices may walk the band for some time. That's kind of what I just said to you there. Just be prepared that these prices could walk along the band for a little bit of time. Again, this is the same idea that we just talked about. The price can push into the upper band or down to the lower band for quite some time and keep walking that band. Let's look at an example here. Notice this is on the Aussie US dollar. Look at how we did not really have a squeeze. Look at my indications here. My bandwidth is relatively high. We had a much lower bandwidth just a month earlier, but this trend was really starting to pick up steam, believe it or not. You look at your percent B, it's very low down here. It's down below the 0.2 level, and it's actually moving down. And then if you look at these candles, they're starting to push into that band, and you're starting to see the the bandwidth moving up. When you start to see the bandwidth moving up, even though you did not have a squeeze, that bandwidth's going higher, it's showing that strength is coming in, that volatility is coming in, and in this case, the trade's rolling over. In this case, you could have gotten into this trade around 0.85, and you really didn't get strong exit signals. We started pulling away from the band down here, starting to create a bottom. That was around 0.81, so you had a good 400 pips on this trade. That's a great profit in the world of Forex. So this is a really, really good trade setup, and you're going to see these very often. Sometimes you'll see these also where they just keep going, they keep going, keep going. This is kind of a one wave and done deal, but sometimes they'll just keep going for multiple waves, and you can trade these trend trades inside the Bollingers oftentimes for 3 or 6 months, just kind of back to back, just keep going with them. Let's get over and do some back trading and see if we can't learn some more about the Bollinger trend trades.
Okay, so what we're going to do here is we're going to get into a trend trade trader conditioning scenario so we can see how a trend trade sets up. And remember, the key distinction here about the trend trade is that we are going to either be buying strength into the upper band or selling weakness into the lower band. And so we've got a setup here. Remember, we typically are not going to get all of these signals just from the bands. We're going to use some other tools here. So the tool that I've pulled up is our stochastics indicator. And I've actually gotten rid of the bandwidth indicator. That's not really going to help us in this particular trade setup, so I've gotten rid of that. Now, what I want you to pay attention to here is notice that we are actually at the lower band in a widening bandwidth scenario. You see how those bands are widening? And look at our stochastics. Our stochastics are overbought crossing down. This is extreme weakness. When you're overbought crossing down, you expect a bearish move. If you're already at your lower band, that is selling weakness into the lower band. So what we're going to do here is we're going to take this trade somewhat on faith that this is going to be a bearish move, and all we're looking for is another continued bearish day. Now you realize we've had several back-to-back bearish trades here. We went one day, we had a little spinning top, 2 days, 3 days. So 3 of the last 4 days have been pretty bearish. Normally, you would expect something like that to turn back around, especially at a support level. But look at this weakness we've got. And so that's what we're selling into. And we're selling at the lower band into the weakness that we see showing up here in our stochastics. And so our entry on this trade is going to end up being here about $87 or so. $87.40 approximately right in here. So we'll just write that in there, $87.40. That will be our entry into this trade. Okay, so let's move the trade forward a little bit. And next trading day, notice what happens. It actually moved up. Again, we're going to be using a parabolic for this stop. We'll leave the parabolic in here. This is a trend trade. Now remember, we're watching for this thing to move between the middle band and the lower band. That's what we're watching for here. So we're selling this weakness. What I like to do in a case like this, in a perfect world, you can actually sell right at the middle band. So you can have your little entry down here at 87.40, or we can sell as we trade up to the middle band and we show more weakness. That would be an even better scenario. So let's see if we get any candles to suggest that up here at the middle band. And there we've got a little spinning top up here to suggest just that thing. So realize if this was weakness at the lower band, it's certainly going to be weakness pulling away from the middle band. So now we can actually adjust our entry and we can come on up to about $90 if this trade starts to move bearish from here, making that turn there on that middle band. And there it is. Okay, so now what we've got weakness at the lower band. As you see evidenced here with your stochastics, we corrected a little bit into the middle band, and you see that very bearish candlestick formation. That is a great shorting opportunity. I mean, this is, you can't find a better textbook scenario of when you should short a stock or when you should buy puts. So let's watch this thing. There's your next trading session. We went in here around $90 a share. That's your bearish trade. Next trading session, you see what's happening. Look here, this is a little different than the squeeze play. With the squeeze plays, you're right outside the band. You're kind of walking along the band here. Here, what we're doing with the trend trade, we're between these bands. And remember, our stop is up here right now. Following the parabolic, we're about $92 a share. So we'll just keep moving this thing along. And of course, in the real world, it's going to go a little slower than this, but there's a little gap down, and you're pushing into that lower band now. Now you have real weakness into the lower band. That was your first weakness. Remember, you're crossing bearish on your stochastics at the lower band. That is an odd signal. You don't see that very often, so there's a lot of weakness there. This was just a little bear flag corrective move. Then we got the gap. I mean, this thing is really turning into a monster bearish trade. Our parabolic now has almost caught up to a break even, and this trade is really starting to hum along. Now what we're watching for is we're looking for candlestick signals to suggest we get out of the trade. We've got some long lower shadows starting to build along the lower band here. These could be exit signals. If you're happy with a $5 profit, you could get out of the trade, or just wait, keep tracking with it, because remember, this is a trend trade. This will typically go a little bit longer than just the initial explosive move of a squeeze play. We're going to have a little retracement here, it looks like. If you keep tracking along with your parabolic, you see your parabolic has now moved down to 89.40, and we'll just keep tracking along with this trade. There's another little gap down. And we'll keep trading this until we have some really solid signals to get out of the trade. In a trend trade, you will walk along this band just like we're seeing here. Okay, now what we're going to be looking for is we're looking for weakness in the bearish trade, which means we're seeing some buying pressure, we're seeing some strength. Notice how this trade has transpired now. We went from weakness at the lower band, as you saw in the stochastics here. Now we're very oversold, and we're starting to get the first signs of some bullish divergence, and we're starting to pull away. Notice this is the first time we've really had solid bullish divergence with our percent B here. We'll keep tracking this a little bit more. There's another drop down bearish day. Again, look at your parabolic. Now your parabolic has started to accelerate. We're down to our stops at $83. So this is starting to really set up, and boom, there's your first real warning candlestick formation. That's the first really big one you've got. And look at the divergence you've got now. This divergence was not in place up here when we had the little gap up. That divergence was not in place, but now we're oversold on your stochastics. You got a strong divergence picking up on your Bollingers. You've gone a long way. You're actually, if you look to the left, you're at a good support level. This trade is coming to an end. This would be a great time to get out of the trade. You could wait and stop out. You'll get out around $83, or now that you see this bottom here, you should really consider getting out about $82 on this trade. Now remember, we went short around $90 a share, so that's about $8 per share. It's a nice little trend trade. Let's see where this play goes. You can decide how you want to get out. I think it's going to get out the next one. There it is. So if you stopped out at $83 with your parabolic, then you're out of the trade. If you got out a little earlier, you would have gotten out a little bit below $82 there. But either way you look at it, that's a really nice little trade. And this is very typical of the way you will see a trend trade shape up with your Bollinger Bands. So you'll have that weakness. In this case, we're selling the weakness into the lower band, and we're just tracking with it using the parabolic as kind of a trailing stop. And then when we start to see the exit candle signals, and we're oversold with the stochastics, and we got the bullish divergence with your percent B, great exit signals. Those are all excellent excuses to start getting out of a trade like this right here. So there's a Bollinger trend trade example. Okay, for this trend trade example, we're going to look at a bullish scenario. And what I want to bring your attention to is, first of all, look at how these stochastics are moving up. So you see moving up momentum from the lower band. And as I run it forward just a couple of trading sessions here, watch what happens. Within 2 sessions, we're at the upper band and we're outside of the upper band. This is important because, see, now we're out of the upper band, and look how much room your stochastics have. There's so much strength coming into this move. And so you recognize that this trade is starting to go higher. By the way, this is Alaska Airlines. So ticker symbol ALK. That's what I'm looking at here. And so when you see that, where do you set your entry? You set it just above it, just around almost $46 a share. That'll be your buy signal here. It's about $46 a share, just kind of going with it here. And again, we're going to use our parabolic stop. Now, this is a trend trade, so we're going to be in this for a few weeks probably. That's typically the way you're going to watch this play out. And let's see what happens the next day. There's your shooting star. Now, you could start to tighten your stops if you're really worried. Take a day's worth of profits. But, this is a trend trade. This thing can cycle back down to your middle line, and it can do something like this. So we'll keep tracking it here just a little bit. And watch what happens. We got a bearish engulfing pattern the next day. And then it starts to soar. And this is the way a lot of trend trades will happen. You'll get a surge of energy right outside the band. It wasn't really a squeeze. You see, that wasn't a tight squeeze like what we had even back in September. But you were still having kind of similar to the squeeze. You got that push, that surge of energy up into the upper band as the strength is building and some other indicators and some other fundamentals and whatnot. And then as the trade starts to move, look at that. I mean, we're just pushing right outside the band, starting kind of that walking the band. Now, once you start walking the band, you're going to ride this thing for quite a while until it starts to pull away. Now, this is the first signs of pulling away. And you see your parabolic, you got money in the trade, but not much here. I would just go ahead and split that, put your stop up here maybe around $50. once it starts the first part of pulling away. You could take your profit, realize if we got into this thing at 46, which is where we said we entered, and you're already up here to 51, you got quite a bit of profit in that trade, especially if you're doing an option trade. But the trade's not done. Watch this. It keeps going here. Another little doji, a little bit higher. Now your parabolic is really starting to accelerate. There's where that acceleration factor comes in, as it feels like this move is starting to slow down too. And watch how this trend trade develops. It just moves right inside the band. Now, there is a really good reason to get out of the trade. It's a bearish engulfing pattern at $53. That would be a good excuse to get out of this trade. It's not mandated, but it's a good excuse. But watch what's happening. This is what I want to bring your attention to. This has shifted now, okay? When we were over here just, 4 or 5 trading sessions ago, percent B was starting to look a little weaker, but look at it now. Percent B is heading downhill while the stock's been going uphill. Now we got the exit candlestick. Are you starting to see the pattern here? Every one of these exit signals pretty much has a candlestick formation, and we're way overbought in our stochastics. You can put a stop in here now right around $53 and just be done with this trade. And just be done with this trade. If you did that, then that was probably a good move as the trade starts to move sideways here. One little surge higher, but the weakness is definitely coming in. You can see that strong bearish divergence now. Your stochastic still pushing it overbought. Yes, we're a little bit higher. We made another couple dollars in there, but the weakness is coming in, and this thing's going to reverse on you very quickly here. There it is. It's got to be happening pretty soon. There it is. So what you saw right here is you just saw the parabolic shift, which means we just hit the parabolic. So if you waited till the parabolic, you would have gotten out about 54.88. If you got out at the first sign of trouble, you would have locked in about $53. Now, which one's better? Well, a lot of people would wait for the trailing stop to catch up and stop out. I don't like that because you end up always selling on a downtick. Sometimes in a scenario like this, you get an extra dollar or $1.88 and it works out well. But more often than not, what happens is if you trade to your first exit signal, or in the case of where you've got a target that's clearly defined, you trade to your first target and you get out, over time you will have more consistent profits than the trailing stops. So I like the parabolic system, which is kind of a variation on a trailing stop. I like it a lot for setting your stops. I try not to stop out. That's the truth. The truth is I'd rather get to a target and get out of the trade. So either way you exited this, it was a very profitable trade. If you did the first way, where we got in at 46 and you got out up here about 53, then you had about $7 per share. If you did the second way, where we got in at 46, and if you waited till you stopped out, you got out about 54.88. And so, that gave you a couple extra dollars there. You had about $8 worth of profit and some change. So there's another little trend trade for you.
Finally, that brings us to our third play with the Bollinger Bands. We call it the reversal. Now, Bollingers are really great for showing various phases of the trend. The squeeze play helps us at the beginning. The trend tray helps us at the beginning and during the middle of the trend. The reversal is really great because it helps us see when that swing and when that trend is coming to an end. Now, what's interesting about the reversal is a lot of people dismiss this picture that we see in the Bollingers, but oftentimes, if you use it right, it can actually be one of the most profitable trades because it can provide one of the greatest risk rewards. So let's see what we're talking about here. So as we think about the reversal trade, the easiest way to think about this is that it anticipates a trend reversal, both a swing reversal and a full-on trend reversal. And it provides one of the best opportunities for a high risk reward trade. Now here's a distinction for you. With the reversal trade, we are selling weakness at the upper band and we are buying strength at the lower band. This is a distinction that's different than the squeeze and the trend trade. With the squeeze and the trend trade, we were buying strength at the upper band and we were selling weakness at the lower band. Here we're flipping it upside down. We're selling at the upper band, and we're selling when there's other signals that are telling us it's weak, and we're buying at the lower band when, again, there's signals that are telling us that it's strong. Now, what kind of signals am I talking about? Well, it could be fundamental signals. More likely, the one I like to use is your oscillators. So I will typically use a stochastics oscillator to help confirm this, but you could use other oscillators as well, which we'll look at here in a few minutes here. So let's look at some rules for the reversal trade. At the tag of the upper band, when the trade gets up to the upper band, we're looking to short, or in other words, to go bearish. So you could short the stock, or you could buy puts. You could do any other type of a trade you want. That's a bearish trade. But at the upper band, you're looking for a bearish trade. And here's what we're looking for. We're looking for your percent B to be diverging down. There's a distinction right there. We're diverging bearish there. And we also are looking for your stochastics or some other oscillator to be overbought and crossing down. Again, that's a distinction that we've not had with the other trades. And then finally, here's what we want to do. We want to enter on the first strongly bearish day following this setup, and then flip around, turn around, set a stop on your parabolic. So notice this is a totally different picture than what we've looked at for the squeeze and for the trend trade. Now this is the bearish setup. Let's look at the bullish setup. The bullish setup is going to be a tag of the lower band. So the trades come down, it tags the lower band. We're looking to buy or to enter a bullish trade, whether that be buy calls, do a bull put spread or any other kind of a bullish trade here. But we're looking to enter into a bullish trade. Your percent B should be diverging up, and your stochastics oversold and crossing up. And then finally, we're going to enter on the first strongly bullish day, and of course flip around and set a stop based on your parabolic. Now I specifically tagged the stochastics as one of the indications to help confirm this trade. I've done that because most of our viewers here are going to have already a basic understanding of stochastics, first of all. Secondly, it's one that I really like to use, and it works really well. You can use other signals as well. If you find a signal with a MACD that you like, I find that one lags a little bit more, but if you find one that you like, you could use that. Maybe you like the commodity channel index. Any of the good oscillators that give you good overbought signals, if you see them setting up with this setup, you could replace that stochastics chunk with it. Also, you could use this with some fundamental analysis. If you see strong fundamentals and you're at the lower band and you see some of these signals setting up and the fundamentals are really strong, that's a great buy opportunity. Or vice versa, if you're at the upper band, you see some of these signals setting up and you've got really weak fundamentals, that would be a good shorting opportunity. Really, the idea here is that you're buying at the lower band when you've got a lot of strength showing up, and you're selling at the upper band when you've got a lot of weakness showing up. However you come at that strength or weakness, whatever you use to get there, that's going to be up to you, and you can plug that into your own trading system there. Let's take a couple of examples and notice what we've got. Notice that we were pushing outside the band. You see, it looked very strong, and then it starts to come inside the band, and look at the confirmation we've got. Your percent B is diverging down. So this is a natural setup here. Your stock is going higher, percent B is diverging down, and we're overbought, crossing bearish on your stochastic. So we want to short on the first strongly bearish day, which was this black candlestick you see on the right side here. And you want to cover your trade or exit the trade at the lower band. That is the reversal trade. Now in this setup, the reason it becomes such a profitable trade is it has a good risk reward. You're getting in at an extreme and you're trading to a specific target. So look at how this worked. If we use the whole system that I just shared with you, use your parabolic stop. You see that little dot right there? Every one of your charting software should give you the dot in the same spot. And when you see that dot, that's where you're going to set your stop right there. So in this case, that stop would be at $71.14. Our entry was about $68. Our target, $61.16. Now, this target, when we got into the trade, would have actually been lower, but of course, those bands are coming closer and closer. So when we finally got there, it was $61.16. And so had you done this trade with those entry and target and stop setups there, our risk reward would be $6.84 to a $3.18 risk. That's a little bit better than a 2-to-1 risk reward. If you do that with a put option, that's going to work out really, really well. You can do it with a stock trade as well. There's a lot of ways you could do this, but the idea here is it's a good risk reward trade. It's a high probability trade because we had that weakness at the upper band, and that sets you up for the trade to reverse and to go the opposite direction, as we saw here on this Alaska Airlines trade. Let's take another example here. This is on Halliburton, and I've got two pictures that I want to share with you here. Let's start with the one in the middle. You see where it says, yes, this is the confirmation. We've got a strong bullish move here, and then we start to see the weakness coming in. We're at the upper band. There's the tag of the upper band in the face of bearish divergence on your percent B and your stochastics crossing down. This is a really good trigger right here. This one is very consistent. I've tested it. I've worked with it a lot. It's a very consistent setup that I'm showing you right here. And you short on the first strongly bearish day. If you want to add one more level of confirmation, take a look here and notice you've got an evening star candlestick reversal. So there's one more level of confirmation that, hey, this thing's really running out of steam at the upper band there. You ride it down to the lower band, and here you have two opportunities. You could cover initially at about $52, and if you just walk the band down, it finally starts pulling away from the band down here around $48.50, $49. So you had a really good risk-reward trade. Now let me contrast this with another picture, and this is the one that's on the left where it says no. Take a look here. We're pushing into the upper band, but we do not have divergence on percent B, and our stochastics are not even overbought yet. That's a no. You also notice if you look just slightly left, that is a squeeze that's breaking out. So one distinction that you could make, one observation, is you'd limit yourself. You say, I'm only going to do a reversal trade after I've already seen a big surge of activity. It doesn't make any sense if you're in a little squeeze like this to think, oh, I'm going to go do a reversal trade. Then you're looking for a head fake, not a reversal. The reversal is going to come after some momentum. If you look at this picture, you see we had the breakout here. We had a little trend trade for about a month or so, and then there's the reversal signal. That's the one you want to take. That's the one you're looking for. Now, the way this plays out is usually, more often than not, one of two ways. The way it plays out is either it plays out perfect, like I just shared with you here, and it trades to the other side of the band, or sometimes it trades sideways. More often than not, it's one of those two. It's pretty rare that you see this trade set up and then it turns around and it takes off in a new bullish trend. That's relatively rare. It can happen, but it's not the most common thing to happen. So this becomes a high quality risk reward trade where you got a high reward for the risk you're taking, and it's a fairly low probability that the risk is going to get fully realized. Usually you'll either break even or you'll see your reward on it. It's a very good trade setup, and as we start to do some back trading and some trader conditioning on this, you're going to see some of these as they come into practice here. Let's make some observations before we get over there, though. The reversal plays can be very profitable because of the quality of the risk and the reward. They do require some faith. This is one of the hardest things about the reversal trade is it does not look like it's going to do what it's about to do. And so it requires some faith. That's why it's really important that you go practice it a lot, do some trader conditioning on it, get really comfortable with it, and do some virtual trades with it. See if you can really get into the sync of it. It's one of those things, once you get into the sync of it, you'll be able to do them. But until you really believe in it, until you've done a few of them and you start to see them really work, you're always going to be kind of thinking, this doesn't look like it's about to reverse on me. And sure enough, that's about the one that will. But learn to do it, and it's a really good trade for you. Let's go do some back trading on this and see if we can really ingrain it into our minds what it should look like.
So now what we want to do is we want to go through a reversal setup or two and, kind of do some conditioning on this so that we get an idea of how this one's going to set up. Let's take a look at this trade setup we've got on Alaska Airlines. And notice what we've had here. We've had actually a bit of a trend trade set up back over here. In fact, I used that in one of the other examples, and then we had the exit signals here. This one was even really a better trend trade. It almost looks like a squeeze. It's kind of right in the middle there. You don't have a really tight squeeze. A really tight squeeze would be exampled over here in September. So you see how much wider these squeezes are. If we had our bandwidth indicator on, you would see that. This is more of a trend trade where it's starting to push into that upper trade there, or that upper band. And in this case, it was doing it with strength in the stochastics. Well, watch what's happened. The bands have continued to expand as you go through here. And now we get kind of that final surge. This is why the reversal trade takes courage. Look at that. You're thinking this is a really bullish trade, but look at what's happening with percent B and with your stochastics. And watch this. I'm going to zoom in just a little bit so we can see it a little bit better. Watch what's going to happen. And notice how tight your parabolic has become. So all these are starting to become signals that things may be slowing down. When your parabolic's that close, you know things are getting close to slowing down. There's one more last bullish surge, and then boom. Watch what just happened. Several things just happened on this one candlestick right here. Your candlestick formation is what we call a one black crow. This is a very weak signal. It suggests bearishness is coming in, and it's going to come in fast. The next thing that happened, your parabolic flipped over. So it is now officially telling you I'm in a bearish trade. And look at your percent B. Look at that divergence and the beginnings of a bearish cross with your stochastics. Boom, boom, boom. This is strong weakness at the upper band. This is a shorting image here. This is the reversal. As you're starting the beginning of pulling away from the band, your parabolics is flipped bearish here. Your stochastics is flipping bearish. Your percent B is diverging like a madman here. So what are we going to do? Well, we're going to be courageous, and we're going to put an entry in here. So we're going to put an entry in here about 66, 63, give or take a few pennies, and we're going to put a stop at our parabolic up here, okay? So our parabolic is going to be at 7102, give or take, just a few pennies there, but approximately 7102. That will be our stop. And if you measure your risk on this trade, you've got about a $4 or $5 risk sitting there. Now, watch what happens. Our target's going to be down here. Our first target is going to be the lower band. We got a long ways to go to get there. So let's see what happens as we trade this thing forward. And here it goes. Now, you're going to have to trust this thing. Remember, we're believing in this reversal here. And at this point, you're maybe a little curious, but you're tracking your parabolics there, and we're going right down to the lower band. And you see how this is happening? There it is. So there's our first band tag, just barely tagged it right here. That is around $61, $62, depending on where you get out there. So had we gone short at 66, 63, you've got about $6 or $7 roughly. Again, it all depends on where you get in and out. Worth of opportunity there. Now, if you trade this thing further, if you held it much longer here, you're going to start to lose some of your opportunity. Watch this. There's your parabolic shifting on you. Finally shifted over. And so once you see that, had you not already gotten out, you should have gotten out at the parabolic shift, which would have put you up around $64 or so. Still would have been a profitable trade, but not as profitable. And this is another good learning opportunity. If you can recognize that reversal and you trade it to the other side, it's really, really profitable. But if you wait until you stop out, you're always going to give back a huge part of your profits. That's why I like to trade to a target and get out of the trade. This is the Bollinger reversal trade here. Again, let me highlight a few features here that was setting this up. Candlestick formation, one black crow. The parabolics had flipped over into a bearish scenario. Strong bearish divergence. Your stochastics was showing weakness, all at the upper band. This is not a signal of a bearish trend. It's a signal of a bearish swing, and the preceding bullish trend is done. That is a reversal. And in this case, it gave us about $4 or $5. A lot of times this trade right here will give you one of the best risk rewards that you can have. So that's why the reversal is a very powerful trade.
We're just about to the end of our Bollinger Band Essentials training here, so I want to do a quick wrap-up. Before we do the wrap-up, I want to remind you, Bollinger Bands are a great addition to your analysis. They are a complete trading system in and of themselves. If you choose to do that, you can blend it with some of the other techniques. There's just a lot of ways you can adapt this information. So what I want to encourage you to do is I want to encourage you to go out, start practicing it, start working with it, and kind of adapt it into something that works for you. In our original Foundations of Stocks and Options, we use Bollingers as one of the indicators. Here, what you've seen presented in the Bollinger Essentials training here is you've seen taking it to a different level where you've got a lot of opportunity to really just keep all of your trades inside this picture. It really doesn't matter. There's no right or wrong. You can adapt these tools to use in your own trades the way you like. You could lean 100% towards just using a Bollinger system. You could use it more as kind of a light confirmation like we've used it in Foundations. However you choose to use it, it's going to work well for you. And they're great tools. And I really encourage you to dig deeper than just watching these videos, but actually go out and practice it and try it. So as we start to do a wrap-up, let me kind of give you some highlights here. Bollinger Bands provide a relative definition of highs and lows, as opposed to an absolute definition of highs and lows. When we look at support and resistance, that's a very absolute. When we look at drawing channels, we look at some of the other tools that we've used in other classes, those are very absolute definitions. What makes Bollingers unique is it's very relative, and so because of that, there's a lot of flexibility with the Bollinger tools. The highs and the lows are not necessarily absolutes, as we've just talked about. They may lead to continuation or they may lead to reversal. As we've looked at in several of the plays here in this class, sometimes you buy at the top into strength and sometimes you sell at the top band. The upper band in and of itself, it does not mean it's time to go down. The lower band does not mean it's time to go up. They can work multiple ways. What the bands are doing is giving you that relative definition of highs and lows. Another benefit of the Bollingers is they can be used to help clarify our patterns. Remember, our Bollingers are built on the simple moving average. You don't want to plug the exponential in there. All the deviations are drawn from the simple. So you want to use your simple moving average. The basic setting is a setting of 20 with a standard deviation of 2. You can adjust that. We've given you some examples of what you can adjust that to, or you can play with your own as well. Remember, the averages outline the intermediate trend. So when you look at the Bollingers, it's outlining more the intermediate trend, not the minor or the primary level trend. You can use Bollingers across multiple time frames. So if you want to, set up a trade on the daily chart, then go into an intraday chart, look for a confirmation. That's one way you can do it. I know some traders who will set up 3 different time frames, and when they get the same signal in all 3 time frames, that will be their entry into the trade. However you choose to use it, you can do so. Bollingers are used as a relative framework. Instead of going and charting your stock from scratch and building that full framework like we teach in Foundations, you can use your Bollingers as a very relative framework. That's one benefit that a lot of people like. Remember, there's 3 main plays. We've got the squeeze play, the trend trade, and the reversal. And of course, inside the squeeze play is the head fake, which is a very important distinction there. And then finally, percent B and bandwidth can help bring really great additional clarification to your trades. These are a couple of indicators that you've learned about in the program that are tied in specifically with the Bollinger Bands. Now, if you want to learn more about Bollinger Bands, who else to learn from than John Bollinger himself? You can still hear him speak at various public events around the country. He doesn't speak a whole lot. He's not doing weekly seminars necessarily, but usually once or twice a year, you can have the opportunity to find him somewhere and learn some stuff from him. He's also got a book that he wrote about 10 or 15 years ago, Bollinger on Bollinger Bands, and then he's got a website to support that. A lot of the research that I've done in this program has come from the research that I took directly from John. I've had the opportunity to sit down and have dinner with him and meet him and learn directly some things from him. I've referenced his book quite a bit, and if you guys choose to do so, that would be an additional resource for you as well. The best resource, though, for additional information is going to be you as you go out and you start practicing this stuff on your own. The best learning that I've ever been able to pull into my own trading here is whenever I take the principles from a book, take the principles from a website or from videos or whatever, and then I go actually do it. You're never going to go find the video that's going to give you the skill set. You're never going to find the book that's going to give you the skill set. The way you get the skill set is to go out and practice. And so that's what you need to do as you start to learn to be a perfectionist and an expert at working with Bollinger Bands. With that in mind, let's do some homework here. Here's your homework. Review the videos. You've got 4 classes and several videos to review. Start back trading, do the trader condition process on each method. That would be each of the plays that we've talked about here. Start with 1. I really encourage you to start with 1. Start with the squeeze play. Start with the trend trade, the reversal. Pick one and get really good at that one and then expand. If you come in here and you start trying to learn how to do a Bollinger trade system here and you try to be a perfectionist at all of them, you're just going to be really frustrated and you're not going to be able to master any of them. So start with one and then perfect that one and move on. And of course, as always, with all new trading systems, virtual trade it first. Virtual trade the trading systems first. Prove it to yourself. I suggest a minimum of 10 virtual trades so you can start getting a statistic. But, ideally 10, 15, 20 virtual trades before you ever start considering real money here. And then finally, be sure to write a plan and follow it. It doesn't matter what trading system you're looking at. If you're looking at Bollinger Bands or Ichimoku or our basic 5 steps of trade confirmation system that we do in the Foundations program, whatever trading system you look at, you've got to write a trading plan and you got to follow it. If you don't follow it, guess what's going to happen? You'll be in the middle of the play, be in the middle of the trade, and something's going to come in, it's going to distract you, and that's the moment that you're going to get off track and you're going to divert over here, and before you know it, you're losing money and you're saying, why am I losing money? And it's as simple as you didn't plan very well. So I hope you've enjoyed this Bollinger program. I hope it's brought a lot of insight to you. Please send us some feedback, send us emails, let us know what you think, and as we move forward, we'll certainly be updating the program. Until we meet again, happy trading to all of you.